All right. Welcome to Investment Banking Insights. This is the only show dedicated to helping you learn both the technical and non-technical aspects of the investment banking process. Hi there. My name is Alex Mason and I am your host. Thank you for joining me today. We're going to be talking about what happens when you write down $100. And we're going to look at this from the perspective of the financial statements, both in terms of assets as well as debt. So let's go ahead and go to the whiteboard and see how this works on the financial statements. Okay, so the first thing we want to do here is we have our income statement, we have our cash flow statement, and then we have our balance sheet. And if we're writing things down, first remember the balance sheet has our assets, has our liabilities, and our equity portion. So in a write down, what's actually going on with, let's say we have a $100 asset. Well, we want to actually see first what happens on the income statement. So the way that this works is when we record the $100 write down of the asset, we're basically saying that we have higher expenses because we're saying, oh, wow, like we don't really think that this asset is worth $100. Let's say that it's worth $0. So expenses are going to increase by 100, and that's going to in fact impact our operating profit, which is going to go down by $100 as a result. Now let's go ahead and assume a 40% tax rate. So if we have our taxes, that's going to be $40 of taxes, and then our net income is going to go down by $60. So net income flows into the cash flow statement. That's what's next. So we have our net income at the top of operating cash flow go down by $60. Now, because we're writing this asset down as a complete loss, remember, this is a non-cash charge, so we have to add this back to the cash flow statement in order to understand the actual amount of cash that changed hands here. So what we're going to do is we're going to add in the write down, and this is going to be a plus $100 adjustment, which gives us an extra $40 in operating cash flow. Okay? All right, so that's the cash flow statement. Now let's go ahead and move over to the balance sheet. And there's no other changes to the other sections of the cash flow statement. So our net change in cash is plus $40. And remember, cash is an asset, so it moves over to the balance sheet. So our cash is increased by $40. And then we just said our asset is now worthless, right? So it's now $100 is now worth $0. So the value of our asset write down is going to go down by 100, and this is a net change of negative $60. So $60 going down. Liabilities, we haven't changed any liabilities, so no update there. And then for our equity, remember, net income flows over to retained earnings. So we're going to take this and move it over here. So retained earnings goes down $60. And guess what? Balance sheet balances, because our assets went down by $60, our equity goes down by $60, and there's no change in liabilities. And that's how it works when you're doing a complete write down of an asset. Now, I want to do an example of the same exact thing, but instead of writing down an asset, we're going to write down a liability. And this was a little confusing for me at first when I learned it. Like, how could you write down a liability? It's not worth anything, is it? Well, it is worth something to the debt holder. right? So just like if you own a house that's worth $300K, you could write down the value of that house. If you have a mortgage of $300K on that property, that debt could be written down by your mortgage lender. So that's how that would work. So let's see the nuances of how this changes the situation with our financial statements. Okay, so with writing down debt, if we write down debt from the company's perspective, this is going to be a good thing in terms of profitability, right? Because if you owe some money and all of a sudden you owe a lot less money, that's going to increase your profits, right? Because you no longer have that debt on your books. So this is going to impact the income statement in the following way. So if we say that there's revenue minus expenses, let's say our operating profit is actually going to go up by $100. And that's because we're writing off this debt. It's a benefit to us. Now, in terms of taxes, let's assume a 40% tax rate. So let's assume $40 of taxes. Now our net income is going to go up as a result by $60. Net income flows to the top of the cash flow statement. So net income up by 60. And then because we are writing down the debt, instead of adding this back, we actually have to subtract it because this was a gain for the company. And it was a non-cash gain. There wasn't actually cash that happened to change hands as a result of the debt write-down. So we have to adjust for this on the cash flow statement. So what we're going to do is, this is the write-down of the debt, remember. So this is going to go down by $100. And so our operating cash flow ends up changing by $40 and negative $40 basically. And there are no other changes to the other sections of the cash flow statement here, so we can go ahead and go right to the balance sheet. Here's our assets, liabilities, and our equity. And so our operating cash flow is down $40. And so net change in cash down 40. This flows up to our cash. Cash is down $40. And that's all that happens here on the asset side of the balance sheet. There's no other asset other than cash we have to consider here. But let's look here at liabilities. Because we're writing down debt, the liabilities on our balance sheet have now just been wiped away. So our liabilities, because of the write-down, are going to go down by $100. And then for equity, net income flows over to retained earnings. So retained earnings, remember this is up by 60. Up by 60, and overall equity is up by $60. So if we look at the basic equation of accounting, assets equals liabilities plus equity. So our assets went down by 40. So I'm just going to put negative 40. Our liabilities went down by 100, negative 100, and our equity went up by 60 plus 60. This is the same thing, and the balance sheet balances between these three numbers. And that's how you walk through the write-down of a liability on the three financial statements. Okay, so that's what I got for you today here on Investment Banking Insights. My name is Alex Mason, and I'm so grateful that you're here. We're going to be talking about more problems, more situations, things that you should know for investment banking interviews on future episodes. So thank you, and I'll see you on the next one.